Venture capital has funded more than half of all US public companies since 1979, representing about a third of all of the stock market's value. As of the making of this video, all of the top 5 most valuable companies in the US began as venture-funded backed startups. These companies have collectively defined the modern internet as we know it, while serving billions of consumers and employing hundreds of thousands of people around the world. Amidst the race to build the next Google, you may have seen the many splashy startup fundraising press releases as venture capital funding continues to reach new record heights. The biggest venture funds today line the streets of Sand Hill Road and make decisions that sit at the heart of technology innovation, but also geopolitics and social issues. If you want a window into the future of where technology and the world is headed, it might be prudent to follow the smart money. And yet, venture capital is controlled really only by a few dozen venture firms heavily concentrated in Silicon Valley that remain extremely opaque to outsiders. I'm Wayne, a venture capitalist at Signalfire, a billion-dollar fund based in Silicon Valley. In this video, I'm going to demystify what is venture capital and how this small and secretive but influential industry works as the financial engine that helps launch most of the world's iconic tech companies. Within the world of modern investing, most people are probably familiar with the concept of trading stocks in publicly listed companies on exchanges such as the NASDAQ. But you may be less familiar with how private companies get funded. Private equity tends to focus on more mature private companies that have proven their ability to make money, but are often slower growth. Because of that, these funds are generally targeting lower but less risky returns, say 2 to 3x the money invested. PE funds often use debt to buy company shares since the companies are usually generating cash flow that can be used to pay interest and improve returns. Venture funds, on the other hand, specialize in funding startups that have yet to turn a profit, but are often much higher growth potential, sometimes returning more than 100x the initial investment. And venture investors fund tech startups with equity rather than debt, because startups are cash poor out of the gates, but can have enormous upside potential in the future. And of course, there are companies that are sometimes somewhere in the middle. Private equity and venture capital are really two different extremes connected on the same spectrum of private company funding. Today, the world of venture capital has fragmented and become specialized across many different stages of financing that correspond to the life cycle of a tech startup. Historically, the Series A was the first round of institutionalized funding from a professional investment firm. The oldest and most storied venture franchises today first emerged focused at the Series A, such as Sequoia and Kleiner Perkins, a firm where I interned that led the Series A funding for Google, Amazon, Genentech, Netscape, and countless others. Historically, the Series A was a $5 to $10 million round. But as more and more money piled into venture capital as an asset class, these venture funds grew in size and wanted to put more money to work, ideally in the $10 to $20 million range or even more. This is a really important shift. Now, Series A companies are typically generating significant revenue already or have lots of happy users and have clear signs of product market fit. A second very important shift has happened in the last 5 to 10 years. You don't have to spend $5 million to rack servers anymore just to run and host your software products to your customers. Amazon Web Services allows you to basically rent their servers on a fractional basis much more cost effectively. Also, there have been countless microservices that have popped up that let you as a startup outsource any non-core function. Stripe means you don't have to build your own payments infrastructure. Gusto handles your payroll and HR. Pilot handles your bookkeeping. Main Street files R&D tax credits on your behalf. So that means you need less money to start a company than ever before. That opportunity created a gap which has been filled with so-called seed funding. Seed funds or micro VCs invest anywhere between, say, $1 million to $5 million in companies once they have a founding team and the core idea with some early proof points. This funding is intended to help the team find product market fit and then raise the Series A. As the seed ecosystem itself has matured, there's even been some firms who have focused on pre-seed investing in rounds less than $1 million as well. So that covers the phases that comprise what might be referred to as early stage investing. Once a company has largely de-risked the business to a point it's a well-oiled machine that the founders understand how do you put $1 in and get $3 out, it's time to raise a growth round. Series B rounds can be very large, 20 to 40 million or much larger. Companies then continue to raise subsequent rounds to continue scaling, called Series C and D and so on until the company's eventual IPO or sale. These are all called growth rounds and are funded by late-stage specialist funds such as SoftBank, Tiger Global, IVP, and many others. One of the biggest developments of the industry has been companies staying private much longer than before to avoid the headache of increased regulation and oversight of going public. When Amazon IPO'd, it had only 256 employees, 16 million in revenue, and was valued around 300 million. Since it went public, as of this video, it's worth about 1.6 trillion, meaning if you bought Amazon shares at the IPO, you would have made 5,000 times your money. Today, venture-backed startups often grow into enormous businesses generating hundreds of millions of revenue and worth tens of billions before considering going public. So a lot more value has shifted from the public markets to the private markets and venture capitalists. This phenomenon has led a number of public markets-focused investors like hedge funds to chase those returns by making investments in private tech companies. Funds like Tiger Global, Coatue, Dragoneer, SoftBank, and others have flooded into venture capital, increasing round sizes and valuation multiples to record levels. These crossover funds are focused on the late-stage segment of the market that's easiest for them to transition into. As the more mature a company gets, the more capital you have to put to work as a huge fund, and the more that investing becomes a financial or metrics-based exercise for your classic hedge fund analyst. That's in contrast to early stage investing, where there aren't really any numbers, making it much more people and market feel oriented. Okay, so let's talk about venture fund economics. How do these funds actually make money? Venture capitalists don't invest their own personal money. They need to go raise money from what are called limited partners. This can be high net worth individuals who can have professionally managed family offices or endowments like Harvard or Yale, hedge funds, corporations, pension funds, charitable organizations, or even sovereign wealth funds. All of those entities allocate a tiny portion of their money to private equity and venture capital. The venture capitalist investors then make money through what's called a 2 and 20 model. They charge 2% of the money raised as fees each year so that they can pay themselves and any other expenses. Then they buy shares in startups, and over the course of 2 to 3 years, build up a portfolio of investments. Most of those companies don't make it, but a few of them will exit through a sale or an IPO. And when that happens, VCs can sell those shares, keep 20% of the profits, and give 80% of the profits back to LPs. For example, if a $100 million fund returns $200 million, the first $100 million goes back to the LPs, and then the VCs and LPs split the remaining 100, 80-20. One thing to note is just how long fund cycles take. It could take 6 to 12 months to raise a fund, then 2 to 3 years to actually invest it in companies, then another 10 to 15 years for those companies to mature and exit and return capital. So signing up to raise a venture capital fund is a decades-long commitment, and most VCs, especially junior VCs, never see a dollar of that carry. And for that reason, if you're motivated purely by cash, venture capital is probably the worst investor job you can take. That said, there's still a lot of money to be made in venture if you do it well. Of course, most companies fail, but a few big companies can pay for all the failures many times over. When Kleiner Perkins invested in Google, they got in when the company was worth roughly $100 million. Today, it's worth 10,000 times more than that, at more than $1 trillion in market cap. Not every company is a Google, of course. But the point is, this is a game not of avoiding mistakes, but of hitting just a few grand slams. It's all about your slugging percentage, not your strikeouts. And you can make a lot of money if you can hit the long ball. So what does it take to be a good venture capitalist? Well, you have to do 4 things well to succeed, and you have to do all 4 of them. If you don't see good deals, nothing else matters. But it doesn't matter if you see every deal if you don't know which ones are good. And it doesn't matter if you can pick perfectly if you can't convince the entrepreneur to let you invest. And you better be able to help them build a great company, because if not, word's gonna get around and you're gonna stop seeing good deals. Digging into sourcing, there's this concept called proprietary deal flow, meaning you see deals no one else does. I can make a whole video on this, but everyone has their own personal strategy, whether it's building expertise in certain areas that founders find valuable, or hosting events to attract founders, or spending time at university research centers. There's tons of different strategies. A typical VC might see 1,000 company pitches per year, give or take. They're digging deep into lots of those companies and doing research on markets, spending time getting to know the founders, and then trying to pick a handful, maybe even just 1 or 2 exceptional companies to invest in. So what's a VC looking for in that diligence process? If I had to simplify, it's exceptional founders with an unfair advantage in huge, changing markets. Again, I can make a 30-minute video about this, but let's just deconstruct this quickly. There are all sorts of different archetypes, but VCs are generally looking for founders that have a demonstrated ability to learn exceptionally quickly, have gone off the beaten path and taken risks before, and have an intense need to win. Many great founders come from humble backgrounds or have a chip on their shoulder, willing them to succeed. VCs also look for people who have a really deep domain expertise and perhaps have formed a unique insight that others miss or disbelieve. But it's not enough to identify a great way to make money if anyone can just start a copycat business and do the exact same thing. So on that note, VCs are looking for how do you defend the business so you can build something that has lasting market pricing power. And of course, none of this matters if the market you're going after isn't large enough or profitable enough to sustain a huge company. And lastly, it's helpful if there's a compelling answer to why this idea is going to work now. If you assume ideas are cheap and everything has been tried before, why is now the right time to start this specific company? It could be a huge technology enabler like mobile device penetration, or a huge shift in consumer behavior or cultural norms like we're seeing in the pandemic. A lot of the best startups can raise money from whoever they want. So being able to stand out from the crowd and convince an entrepreneur you're a better partner than others is so critical, especially as the number of VCs has exploded in the past 5 to 10 years. Part of this is constructing a deal that's attractive to a founder, but it's not always a great strategy to just overpay and win every deal. You have to show you're a committed and trustworthy partner, somebody who would be great to work with and bring something of value to the table, whether it's expertise, connections, or something else. And last but not least, you got to put your money where your mouth is and actually deliver on what you promise and help the company grow. This is where a lot of your time can go as a VC, and it's the reason it's often said venture capital doesn't scale. What a VC does specifically day to day varies a lot depending on the role. Before I dig in there, it's important to note there's actually a lot beyond just investing activities at a venture fund. You need world-class people who can help with fundraising and investor relations, back office accounting, regulatory controls, in-house counsel and legal issues, and more. But I'm going to focus just more on investing roles for now. The decision makers at a firm are called managing or general partners. They're the ones responsible for fundraising for the fund, mentoring other investors, helping sell and close competitive deals, sitting on boards, and ultimately deciding which investments the fund should make. Then you have mid-level investors who are basically general partners in training, often called vice presidents, principals, or junior partners. They may not formally have a vote in deciding which investments get done, but they're bringing in investments on their own and starting to lead them and sit on boards and develop their own reputation and network. Finally, you have junior VCs called analysts, associates, and senior associates. The first thing a lot of these folks do is sort through all the inbound deals and surface the most interesting ones to a senior VC. Then they provide leverage for the more senior VCs by helping them do market research and other things. For aspiring venture capitalists, it's historically been a very tough one to break into because there's only around 100 high-quality funds in the industry at any one time, and most of them aren't hiring in a given year. But there are more and more new funds every year being started outside of Silicon Valley, opening doors to more outsiders to the industry than ever before. For these new VCs, it can be a long and arduous journey. It can take 10 years for early stage investments to exit and to know whether or not you're any good as an investor. Being a venture capitalist is a bit of a paradox. The best venture capitalists have to develop a skeptic's lens in being extremely selective on deals 99% of the time, but also allowing themselves to dream with a few special founders and recognize when to do so. Every revolutionary idea sounds crazy before the founder pulls forward the future into today. Uber's service involved getting into cars with strangers. Airbnb was about staying in a stranger's home. A lot of VCs said there's no way that's going to work. People think they're going to get murdered. When you look at Facebook, there were 5 other social platforms that were growing faster in the early days, and nobody had built a big business targeting college kids who had no money to spend. In this business, you have to be contrarian and right, seeing non-obvious things before everyone else does and just throws money at the company. So you have to learn not to pay too much attention to what everyone else is saying and learn to think for yourself, sticking to first principles of what you know to be true, even if everyone is telling you you're wrong. But if you get in early and you're right, you have the extraordinary privilege of helping fund amazing founders, building iconic companies, solving the world's most important and valuable problems. If you made it this far in the video, don't forget to subscribe and hit the bell icon so you can be notified. I'll see you in the next video.